Something strange is happening inside the American economy in 2006. On the surface, everything still looks strong. The stock market is holding up, unemployment is still historically low, and government officials continue telling Americans the economy is resilient. But when you dig deeper into the numbers, a very different story begins to appear. In late 2205, the U.S. economy suddenly slowed from a rapid 4.4% growth rate down to just 1.4% in a single quarter, one of the sharpest slowdowns since the pandemic recovery. At the same time, inflation is still running well above the Federal Reserve's 2% target, forcing policymakers into a difficult position where prices remain high even as economic momentum weakens. And now economists are warning that rising energy prices, geopolitical tensions, and a cooling labor market could push inflation in the U.S. back toward 4.2%, while economic growth slows even further. S&P Global. New York Post. What makes this moment so unusual is that the warning signs are appearing quietly and gradually. Not with a dramatic crash, but with small signals spreading across the economy. Hiring is slowing. Layoffs are beginning to rise in certain sectors. Consumer confidence is weakening, and businesses are becoming far more cautious about spending. Even major banks are warning that the economy could begin losing jobs every month as higher oil prices ripple through the system. These are the kinds of early signals economists watch carefully, because historically, economic downturns rarely arrive overnight. Instead, they begin with subtle shifts: a slowdown in hiring here, weaker consumer spending there, rising debt pressure somewhere else, until suddenly the entire economic engine starts losing speed. Business Insider. And that raises a critical question for millions of Americans right now. Is the U.S. economy quietly heading toward a slowdown in 2026? Because if you look closely at the latest data, there are already 10 major warning signs that the economic momentum America enjoyed after the pandemic may finally be fading. Some of these signals are already visible in government data, others are hidden deep inside corporate balance sheets, household finances, and global markets. But together, they paint a picture that many economists are becoming increasingly concerned about. So in this video, we're going to break down 10 warning signs that the U.S. economy may be slowing down in 2006, the signals experts are watching right now, and why these early indicators could matter for jobs, housing prices, and the financial future of millions of American households. The first warning sign that something is changing in the American economy is the sudden slowdown in economic growth itself. For most of 2023 and early 2024, the United States surprised economists around the world by growing far faster than expected. Consumer spending remained strong, companies continued hiring, and the economy seemed to power through high interest rates that were supposed to slow it down. But by the end of 2025 and into 2006, the pace of growth started cooling much faster than many analysts predicted. After expanding at an annualized rate of more than 4% in one quarter, the economy quickly lost momentum and dropped close to the 1% range in the following period. That kind of shift may not sound dramatic on the surface, but economists pay close attention to these changes because economic slowdowns rarely happen all at once. Instead, they begin with a gradual loss of speed. When growth drops this quickly, it often means businesses are producing less, companies are investing less money, and consumers are starting to hold back on spending. What makes this slowdown more concerning is the timing. Normally, when growth slows, inflation is also cooling at the same time. That gives the Federal Reserve room to lower interest rates and stimulate the economy again. But in 2026, the situation is far more complicated. Prices across many essential sectors, especially housing, insurance, and energy, are still rising faster than policymakers would like. That means the Federal Reserve cannot easily cut rates to boost growth without risking another wave of inflation. In other words, the economy may be losing speed while borrowing costs remain high. For businesses that rely on loans to expand, build factories, or hire workers, that creates a very difficult environment. Another reason economists are watching growth numbers closely is because of what they signal about business confidence. When companies believe the future looks strong, they invest heavily in expansion, equipment, and hiring. But when executives start to worry about the economic outlook, they become cautious almost overnight. Investment slows, hiring plans get delayed, and projects are postponed until conditions look clearer. Over time, that cautious behavior spreads across industries. One company slows spending, then its suppliers feel the impact, and eventually entire sectors start feeling the pressure. This ripple effect is often one of the earliest stages of a broader economic slowdown. There are already signs that this shift may be happening. Manufacturing surveys have shown weaker orders. Freight shipping volumes have softened in certain sectors, and some companies are quietly warning investors about slower demand ahead. None of these signals alone guarantee a recession. But taken together, they suggest that the powerful growth engine that carried the U.S. economy through the post-pandemic recovery may finally be losing momentum. And when growth begins slowing at the national level, it usually doesn't stay isolated to economic reports. It begins showing up in everyday life, in hiring decisions, wage growth, and job opportunities. Which brings us to the second warning sign economists are watching closely in 2026. Subtle cracks beginning to appear in what was once one of the strongest job markets in decades. For the past few years, the U.S. labor market has been the strongest pillar holding the economy together. Even when inflation surged and interest rates climbed to their highest levels in decades, hiring remained surprisingly resilient. Employers kept adding jobs month after month, and unemployment stayed near historic lows. That strength created a sense of stability for millions of households. As long as people were working and wages were rising, consumer spending could continue powering the economy forward. But in 2006, economists are beginning to notice early signs that the job market may not be as strong as it once was. One of the first indicators experts watch is the pace of hiring itself. During the peak of the post-pandemic recovery, the U.S. economy was adding hundreds of thousands of jobs each month. That level of hiring created intense competition among employers and pushed wages higher. But recently, the pace has begun to cool. Companies are still hiring, but not nearly as aggressively as before. Job openings have declined from the record levels seen just a few years ago, and more employers are quietly slowing recruitment as they wait to see how the economic outlook develops. Another signal comes from layoffs, which tend to rise slowly before becoming widely visible. In the early stages of a slowdown, layoffs usually appear in specific industries rather than across the entire economy. Technology companies began trimming workforces after the pandemic boom faded, and now other sectors are showing signs of caution as well. Logistics firms, financial companies, and parts of the retail sector have all announced workforce reductions or hiring freezes in recent months. These layoffs may not yet be large enough to dramatically change the national unemployment rate, but they reveal a shift in corporate behavior. Businesses that were aggressively expanding just 2 years ago are now focusing more on cost control. Economists also watch another important signal, called initial unemployment claims, the number of people filing for jobless benefits each week. While the numbers are still relatively low by historical standards, they have shown occasional increases compared to the extremely tight labor conditions seen earlier in the recovery. When claims start trending upward consistently, it often indicates that companies are beginning to cut back more broadly. But perhaps the most subtle change happening in the job market is how workers themselves are behaving. During the peak of the labor shortage, employees felt confident leaving jobs for better opportunities because companies were desperate to hire. That confidence has begun to fade slightly. Fewer workers are voluntarily quitting their jobs compared with the highs seen a couple of years ago. When people become less willing to leave their current positions, it often means they feel the job market is becoming less certain. All of these shifts may seem small individually, but the labor market plays an enormous role in the overall economy. When hiring slows and workers feel less secure, consumer behavior begins to change. Families start postponing large purchases, saving more money, and becoming cautious about taking on new debt. That change in mindset can ripple across industries, from housing to automobiles to retail. And that leads directly to the third warning sign economists are closely watching in 2026, the growing pressure on American consumers, who have been carrying the economy on their shoulders for years. If consumer spending begins to weaken, the impact could spread far beyond individual households and into the heart of the entire economic system. When economists try to understand where the economy might be heading next, they often look closely at corporate decisions. Businesses usually sense changes in economic conditions earlier than anyone else because they see demand shifts in real time. They track sales trends, customer behavior, supply chain costs, and global risks every single day. And when executives start preparing for a slowdown, one of the first actions many companies take is reducing expenses. In many cases, that means layoffs. During the height of the post-pandemic recovery, companies were hiring aggressively. Many industries faced severe labor shortages, and businesses were competing with one another to attract workers. But by 2025 and into 2026, that hiring frenzy began to cool. Instead of expanding rapidly, many corporations shifted toward what they call efficiency strategies. In simple terms, this means doing more with fewer employees. The technology sector was one of the earliest industries to show this shift. After years of rapid expansion and massive hiring, several large tech companies began trimming thousands of jobs once growth started slowing. Many executives explained that they had overestimated future demand during the pandemic digital boom. When consumer behavior normalized, companies suddenly found themselves with larger workforces than they needed. These layoffs were initially concentrated in tech, but the pattern is now appearing in other industries as well. Retail and logistics companies have also started making adjustments. As consumer spending shows signs of slowing, businesses that rely heavily on retail demand are becoming more cautious. Warehouse operators, delivery companies, and major retailers have all begun restructuring parts of their workforce. In many cases, these layoffs are framed as automation upgrades or operational restructuring, but the underlying message is the same. Companies are preparing for a future where demand might not grow as quickly as before. Another important shift happening inside corporations is the rise of hiring freezes. Instead of immediately laying off large numbers of workers, some companies are simply choosing not to replace employees who leave. Over time, this quietly reduces payroll costs without making dramatic headlines. But when many companies adopt this strategy at the same time, it can slowly weaken the overall job market. Economists often view these corporate decisions as early warning signals. Businesses typically act cautiously because they want to protect profits before economic conditions worsen. If executives across multiple industries begin making similar cost-cutting moves, it often reflects growing uncertainty about future growth. And that uncertainty doesn't stop with corporations. It eventually reaches the financial system as well. When companies and consumers both start becoming cautious, borrowing patterns begin to change. People rely more heavily on credit, businesses delay investments, and lenders grow more careful about who they lend money to. These shifts create another powerful signal about the health of the economy. That leads directly to the fifth warning sign economists are watching in 2026, the rising pressure building inside America's massive debt system, particularly the growing burden of credit card and household debt. Another warning sign quietly building beneath the surface of the U.S. economy is the growing pressure from household debt. For many Americans, borrowing has become a normal part of daily life. Mortgages, car loans, student loans, and credit cards are deeply woven into the financial system. In strong economic times, debt can actually help fuel growth because people feel confident enough to borrow and spend. But when the economy begins to slow while interest rates remain high, that same debt can suddenly become a serious burden. Over the past few years, borrowing costs in the United States have climbed to levels not seen in more than a decade. The Federal Reserve raised interest rates aggressively in an effort to control inflation, and those higher rates quickly spread through the entire credit system. Credit card interest rates moved above 20% for many borrowers. Auto loans became more expensive, and mortgage rates surged to levels that shocked many home buyers. For households already dealing with higher prices for everyday necessities, the cost of carrying debt has become significantly heavier. At the same time, total household debt has continued to grow. Credit card balances have reached record levels as many families used credit to fill the gap left by shrinking savings. For some households, the increase was gradual, a few extra charges each month to cover groceries, gas, or utilities. But over time, those balances accumulate, and the interest compounds quickly. When interest rates are high, even relatively small balances can take years to pay down if only minimum payments are made. Economists watch another important signal called delinquency rates, which measure how many borrowers are falling behind on their payments. Recently, there have been signs that certain groups of borrowers, especially younger households and lower-income consumers, are beginning to struggle more with credit card and auto loan payments. While the financial system overall remains stable, rising delinquencies often signal that financial stress is spreading among consumers. This matters because debt pressure can change behavior in powerful ways. When families feel financially stretched, they begin cutting back on spending wherever possible. Vacations are postponed, electronics upgrades are delayed, and dining out becomes less frequent. These small changes add up quickly across millions of households, and eventually, businesses start noticing weaker sales. For an economy as large and consumer-driven as the United States, these behavioral shifts can ripple through multiple industries at once. Retail stores see fewer purchases, restaurants experience slower traffic, and manufacturers reduce production orders. Over time, these changes can reinforce the broader slowdown that economists are already starting to detect. And perhaps nowhere is this shift in borrowing and spending behavior more visible than in one of the most important sectors of the entire economy, housing. Because when interest rates remain high and consumers grow cautious about taking on new debt, the housing market often becomes one of the first major sectors to feel the impact. That brings us to the sixth warning sign economists are paying very close attention to in 2026. The growing cracks beginning to appear in the U.S. housing market. The housing market has always played a critical role in the health of the American economy. When home sales are strong, the impact spreads far beyond just real estate. New home construction creates jobs for builders, electricians, plumbers, and contractors. Furniture companies sell more products. Home improvement stores see higher demand, and banks issue more mortgages. In other words, a healthy housing market fuels an entire ecosystem of economic activity. But in 2006, economists are beginning to see warning signs that this powerful engine may be losing momentum. One of the biggest reasons is the sharp rise in mortgage rates over the past few years. As the Federal Reserve raised interest rates to control inflation, mortgage rates followed the same upward trend. For many potential buyers, the difference has been dramatic. A mortgage that might have cost a certain amount per month just a few years ago now requires hundreds of dollars more for the same home price. That shift has pushed many buyers out of the market entirely, especially first-time home buyers who were already struggling with high home prices. Higher borrowing costs have also created a unique situation where many homeowners are reluctant to sell their properties. Millions of Americans locked in extremely low mortgage rates during the pandemic era. Selling their homes today would mean giving up those low rates and taking on a much more expensive mortgage. As a result, many homeowners are choosing to stay where they are, which has reduced the number of homes available for sale. This combination of high prices and limited supply has created a strange kind of housing market slowdown, one where activity is slowing even though prices remain relatively elevated. Another important indicator economists watch is home sales volume. In several parts of the country, home sales have slowed significantly compared with the levels seen during the pandemic housing boom. Fewer buyers are able to afford current prices, and many sellers are waiting for better conditions before listing their homes. When sales volumes drop for an extended period, it often signals that the housing market is entering a cooling phase. The ripple effects of a housing slowdown can be significant. Builders may delay new construction projects, banks may issue fewer mortgages, and companies that depend on home-related spending may see weaker demand. Over time, these shifts can spread into other areas of the economy. Real estate markets also influence consumer psychology in powerful ways. When home values rise steadily, homeowners tend to feel wealthier and more confident about spending money. But when housing activity slows, or prices become uncertain, that confidence can fade. People become more cautious with their finances, which can further reduce spending in the broader economy. And while housing is one major pillar of economic activity, there is another sector that often reveals early signs of economic stress even before large corporations feel the impact. That sector is small business, because when the economy begins to slow, small businesses are usually among the first to feel the pressure. This brings us to the seventh warning sign economists are closely watching in 2026, the growing financial stress facing small businesses across the country. While large corporations often dominate headlines, the backbone of the American economy is actually small business. From family-owned restaurants and local construction companies to neighborhood retail stores and independent service providers, small businesses employ nearly half of the private workforce in the United States. Because these businesses operate with thinner profit margins and fewer financial resources than major corporations, they often feel economic pressure earlier than anyone else. And in 2026, many small business owners are beginning to send subtle signals that conditions are becoming more difficult. One of the biggest challenges small businesses are facing is the rising cost of borrowing. Many small companies rely on loans or credit lines to manage day-to-day operations, purchase inventory, or expand their operations. When interest rates increase sharply, those borrowing costs rise as well. For a small business that already operates on tight margins, even a modest increase in loan payments can significantly affect profitability. As a result, many small business owners are delaying expansion plans, postponing hiring, or reducing investment in new equipment. Another pressure point is the continued rise in operating costs. Even though overall inflation has cooled compared to the peak seen earlier in the decade, many businesses are still dealing with elevated prices for rent, insurance, utilities, and supplies. Unlike large corporations that can negotiate lower prices with suppliers, small businesses often have limited bargaining power. That means they are forced to either absorb higher costs themselves or pass those costs on to customers. And in a slower economy, raising prices can drive customers away. Labor costs also remain a challenge. While the job market has cooled somewhat, wages in many industries remain higher than they were before the pandemic. Small businesses often struggle to compete with larger companies that can offer better pay and benefits. This creates a difficult balancing act where owners must try to attract workers while also controlling expenses. Another important signal comes from small business confidence surveys. These surveys ask business owners how they feel about future sales, hiring plans, and overall economic conditions. In recent months, many owners have expressed growing uncertainty about the direction of the economy. When confidence declines, businesses become more cautious about making long-term commitments, such as opening new locations or expanding their workforce. This cautious behavior matters because small businesses play such a large role in job creation. Historically, a significant portion of new jobs in the United States comes from small and medium-sized businesses. If these companies slow their hiring or postpone expansion, the impact can gradually spread through the labor market. And while these domestic pressures are building, another unusual situation is unfolding in financial markets. Despite many of the economic warning signs we've discussed so far, parts of the stock market have remained surprisingly strong. On the surface, that might suggest the economy is still healthy. But when financial markets move in a different direction than the real economy, economists start paying very close attention. That brings us to the eighth warning sign in 2026. The growing gap between the stock market and the real economy, a disconnect that has appeared before during past economic turning points. One of the most confusing signals for many Americans right now is the apparent contradiction between the stock market and the real economy. On one hand, headlines often highlight strong performance in major stock indexes, record valuations for certain technology companies, and continued investor optimism about artificial intelligence and future innovation. But on the other hand, many of the economic warning signs we've discussed, slowing growth, rising debt pressure, cautious consumers, and corporate layoffs, suggest the underlying economy may not be as strong as financial markets imply. This kind of disconnect has appeared several times in economic history. Financial markets tend to move based on expectations about the future rather than the current moment. Investors are constantly trying to predict where the economy will be 6 months or even a year from now. Sometimes that optimism pushes stock prices higher even while parts of the real economy begin showing signs of weakness. In 2006, much of the strength in the stock market has been concentrated in a relatively small group of very large technology companies. These firms benefit heavily from long-term trends like artificial intelligence, cloud computing, and automation. Because these companies represent a large share of the total market value in major indexes, their performance can lift the entire stock market even if many other industries are growing more slowly. However, when economists dig deeper into the broader market, they sometimes see a different picture. Smaller companies and traditional industries may not be performing nearly as well as the largest tech giants. This uneven performance can signal that investors are becoming more selective and cautious about which sectors they believe will thrive in a slower economic environment. Another reason markets can appear disconnected from the real economy is the expectation of future policy changes. Investors often anticipate that if economic conditions weaken significantly, the Federal Reserve may eventually lower interest rates to stimulate growth. Lower interest rates generally support higher stock valuations, which can encourage investors to buy stocks even during uncertain economic periods. But this situation can also create volatility. If economic data suddenly worsens or inflation proves more persistent than expected, those optimistic market assumptions can change quickly. In the past, periods where markets seemed detached from economic fundamentals have sometimes been followed by sharp corrections once investors reassessed the risks. This doesn't mean a market crash is inevitable. Financial markets are complex systems influenced by many factors beyond the immediate economy. But when stock prices and economic indicators begin telling very different stories, economists usually treat it as a signal worth watching carefully. And while financial markets debate the future, there is another powerful force shaping the global economic outlook: geopolitical tensions and energy prices. Because the United States does not operate in isolation from the rest of the world, events happening thousands of miles away can quickly affect inflation, supply chains, and economic stability at home. That leads us to the ninth warning sign economists are monitoring in 2026: the growing impact of global conflicts and energy price volatility on the American economy. Another warning sign that economists are watching closely in 2026 doesn't originate inside the United States at all. It comes from the global stage. The modern American economy is deeply connected to international trade, energy markets, and geopolitical events. That means conflicts or instability in one region of the world can quickly ripple through the global economy and affect prices, supply chains, and consumer confidence in the United States. Energy prices are often the most immediate way these global shocks reach American households. Oil markets in particular are extremely sensitive to geopolitical tensions. When conflicts threaten major oil-producing regions or important shipping routes, energy prices can rise rapidly as markets anticipate potential supply disruptions. Even the possibility of a prolonged conflict can send oil prices climbing. For the U.S. economy, rising energy prices can create a difficult chain reaction. When oil becomes more expensive, gasoline prices usually follow. Transportation costs increase for trucking companies, airlines, and shipping firms. Businesses that rely heavily on fuel, from agriculture to logistics, suddenly face higher operating expenses. These costs often get passed along to consumers in the form of higher prices for goods and services. This creates a serious challenge for policymakers. The Federal Reserve has spent years trying to bring inflation down to its target level, but energy price shocks can quickly reverse progress. If oil prices surge, inflation can rise again even while the broader economy is slowing. Economists sometimes call this situation a supply shock, where rising costs hit the economy regardless of domestic demand. Global conflicts can also disrupt supply chains in ways that are not immediately obvious. Key manufacturing components, raw materials, and shipping routes often pass through regions affected by geopolitical tensions. When those supply chains become unstable, businesses face delays, higher costs, and greater uncertainty about future production. Another factor is the psychological effect on financial markets and consumers. When geopolitical tensions escalate, investors often become more cautious, and businesses may delay investments until the situation becomes clearer. Consumers may also become more conservative with their spending when global instability dominates the news. For an economy already dealing with slowing growth, high borrowing costs, and rising household debt, these external pressures can add another layer of risk. Energy price volatility has historically played a role in several economic downturns because it raises costs across nearly every sector of the economy at the same time. And when you combine slowing growth, persistent inflation pressures, cautious consumers, and rising costs, economists begin discussing a term that many policymakers hope to avoid: stagflation. This brings us to the 10th and final warning sign that some experts believe could shape the economic outlook in the years ahead. The final warning sign economists are discussing in 2026 is a scenario that has historically been one of the most difficult economic situations to manage: stagflation. The term combines two problems that normally don't occur together: slow economic growth and persistent inflation. In a typical economic slowdown, inflation usually falls as demand weakens. That gives central banks room to lower interest rates and stimulate growth. But stagflation is different because prices remain elevated even while the economy is losing momentum. To understand why some economists are worried about this possibility, it helps to look at the signals we've already discussed. Economic growth is slowing compared to the strong expansion seen after the pandemic recovery. Consumers are facing rising debt and shrinking savings. Businesses are becoming more cautious about hiring and investment. Housing activity has cooled under the pressure of higher mortgage rates, and at the same time, external factors like energy prices and global tensions still threaten to push inflation higher. When these forces happen together, policymakers face an extremely difficult balancing act. If the Federal Reserve cuts interest rates too quickly to stimulate growth, inflation could surge again. But if the Fed keeps interest rates high to fight inflation, borrowing costs remain expensive for households and businesses, which can slow the economy even further. This policy dilemma is one of the defining challenges of stagflation. The United States experienced a version of this problem during the 1970s when energy shocks and economic stagnation created years of high inflation and weak growth. That period required painful economic adjustments before stability eventually returned. Today's economy is very different from the one that existed 50 years ago, but the underlying concern remains the same. When inflation and slow growth collide, solving both problems at the same time becomes extremely complicated. It's important to emphasize that economists are not saying stagflation is guaranteed. The U.S. economy remains resilient in many ways. Innovation continues to drive productivity in sectors like artificial intelligence and advanced manufacturing. The labor market, while cooling, is still relatively strong compared to historical standards, and policymakers have far more tools and data today than they did decades ago. But economic history shows that warning signs often appear gradually before major turning points. Slowdowns rarely begin with a dramatic crash. Instead, they develop through a series of small signals: a cooling housing market, cautious consumers, rising debt pressures, slowing hiring, and global shocks that add new uncertainty. When economists see many of these signals appearing at the same time, they begin paying very close attention. So the question many Americans are asking right now is simple: what happens next for the U.S. economy? The truth is that economic turning points are incredibly difficult to predict with certainty. Some slowdowns stabilize before turning into full recessions. Others deepen unexpectedly when multiple pressures collide at once. What we know today is that the U.S. economy in 2026 is entering a more uncertain phase than the rapid growth period that followed the pandemic recovery. The 10 warning signs we discussed: slowing growth, a cooling job market, strained consumers, rising household debt, corporate layoffs, housing market cracks, pressure on small businesses, the disconnect between markets and the real economy, global energy shocks, and the risk of stagflation, are all signals that economists are watching closely. None of them alone guarantees a crisis, but together, they suggest that the economic landscape may be shifting. For millions of Americans, the coming years will depend on how policymakers, businesses, and households adapt to these changing conditions. If inflation continues to cool and interest rates eventually fall, the economy could stabilize and continue growing. But if global shocks intensify or financial pressures increase, the slowdown could become more pronounced. Economic cycles have always been a part of history. Periods of rapid expansion are often followed by slower phases of adjustment. The key question now is whether the U.S. economy can navigate these warning signs and maintain stability, or whether 2026 will be remembered as the year the momentum of the post-pandemic boom finally began to fade. And that's exactly why economists, investors, and policymakers around the world are watching these signals more closely than ever before.